Well, it's happened again. We got another banking crisis. We had a huge one in 2007 and 8. I did a video on that. I went into excruciating detail, naming names, funds, etc. Look it up. It's here on Dr. C Invest. Well, the latest crisis involves Silicon Valley Bank, specializing, guess what? Silicon Valley. Here's a price chart over the last year of the stock, and boy, it just fell out of bed, and here it is across the last 10 days. Oh, Dr. Chucky, what happened to the last two? It ceased trading after losing almost everything. Well, don't worry, you have FDIC insurance if it's in the bank for $250,000, $500,000 if it's a joint account, and you also have something called SIPC for securities with a broker. That's for $500,000 with at least a quarter for cash. Let's look at some accounting fundamentals. You have assets. They should equal the liabilities plus equity. And in case of a bank, recall that everything is backwards. Your assets are their liabilities, like checking account, and your liabilities, like a loan, are their assets, mortgage, auto loan, receivable. Now, these values can change, especially if you have a change in interest rates. And boy, have we. We've gone from one of the lowest rates ever to a huge increase, more than doubling in just 1 year. And that change we're going to call duration. I'll explain why. Think of it as a difference, a change, so on. And if that changes, well, it's going to change assets and liabilities. And let's see what happens to that equity. Well, duration is the interest rate risk of any debt or asset instrument. And it turns out it equals the maturity for any zero interest bond and happens to be 1 plus the reciprocal yield for perpetuities, and you'll see it on the graph. Diagonal, zero coupons. At the extreme right, perpetuities. Now, here are the fundamentals. Macaulay thought of this. If you have assets equal liabilities plus equity, and you solve for the equity, assets minus liabilities, and then you throw in the duration, what if we make sure that the equity doesn't change? Which is to say, we immunize the firm from interest rate risk. Here's an example. Have 100 in assets. Duration of the assets is, say, 12. Call it years, because remember that maturity for zero coupons. And you have, let's say, liabilities at 60s. The solution would have you get a duration, interest rate risk of 20 to immunize the firm. Now, notice for a normal firm with positive equity, that's what you want, assets should be greater than liabilities, which requires that the duration, the risk for assets, should be less than that for the liabilities. But banks normally face the opposite. They normally lend to you as their assets 5, 10, 20-year loans, mortgages, autos, etc., and they have liabilities, your checking account, their liability of short-term, which means they normally cannot solve the equation. What do? And to make this perfectly clear, in the case of our bank in question, they faced a greater change in their assets. Here's the same example, and now they have negative equity. Well, some of the solutions are to have a floating rate instrument, and that means its duration is zero. They even have something called an inverse floater, which is a unique financial solution. And the theme here is that, well, the banks make money by getting a higher return on long-term instruments because they're riskier. And, of course, that's the nature of banking. And, of course, risk is commensurate with return. That's why there's banks. And, again, another solution with Dr. C Invests.